I want to get right into the topic. I think the comments from Commissioner Iliad Rosman at the beginning of the panel or at the beginning of the session, talking about the need for better clarity on the price formation process for individual bonds is really at the heart of the matter. I would say that the reason why dealers should care about getting access to pre-trade data is based on exactly what Derek just said in his excellent responses to your question. I just wrote down some of the things that he mentioned, probably didn't write them down fast enough, but he mentioned how dealers don't have enough observable data points, especially in times of stress, to be able to provide liquidity. That's exactly what we are looking to address with our system. We're the only centralized pricing system that allows dealers to see the observable markets of other dealers with some restrictions and protocols in place, of course. This provides the extra data points that allow dealers to hopefully provide more consistent institutional liquidity. But today in 2020, we're at the end of still in the process of a 12-year cycle in which the outstanding size of the market has been growing rapidly. We've all seen also that in 2020, we've already surpassed the outstanding issuance for all of 2019. So this growing market is something that we've been experiencing for quite some time. So there's a larger market for dealers to cover from a market making standpoint. That's why they need greater pre-trade data, access to pre-trade data. We also are aware that the composition of what bonds are coming to market has permanently changed the structure of the corporate bond market. Today, about 44% of the market is comprised of BBB rated debt, which we all know is the riskiest investment grade debt in the market. So now there's a riskier market for dealers to cover. We're also quite aware as an industry over the past 12 years that due to regulatory mandates, market maker balance sheets have been restricted. So dealers are not able to hold the amount of inventory for the amount of time that they've been previously accustomed to. And then finally, and I think that this is something that we've heard from some previous FIMSAC discussions, buy-side institutions have become a lot more sophisticated at aggregating information from multiple dealers in the marketplace. And this has been happening for the past 6 or 7 years. So market makers are really on the wrong side of a growing information asymmetry gap when it comes to pre-trade data. Never in history has the US corporate bond market been bigger or riskier. So dealers care about pre-trade institutional corporate bond data today because access to this information is vital to their ability to consistently provide secondary liquidity while accelerating balance sheet velocity and reducing trading errors.
Thanks, Chris. So you have explained how centralized pricing data helps dealers. Can you explain how centralized pricing data can improve evaluated prices in other areas of the market? And are there any changes that you would advocate to improve data quality for pricing bonds?
Sure, and I do just want to point out to everyone listening that we did provide summary slides that are up on the SEC website. Thank you for posting them. But let's get into the liquidity aspect, because I think that this the lack of organized pricing data in the corporate bond market has been negatively impacting liquidity, and this is exacerbated in times of stress. So, in theory, access to pre-trade market information for market makers allows them to supply more liquidity because pricing information allows dealers to calculate the true risks for supplying liquidity, which improves their ability to stand up to markets. Without pre-trade information, dealers are being asked to make risk decisions with limited information, so they're reluctant to trade bonds that are not highly active. I'll reference what Derek had mentioned. When customers are engaging him and his traders, he's asking them to refresh their market or to reveal what market they are referencing, because it's possible that market is no longer relevant for the time they're trying to do the trade. Again, this is directly the result of not having access to organized pre-trade data. If dealers had access to that data, they would know where the relevant market is almost at all times. Also, in terms of liquidity provision, organized pre-trade information allows dealers to know the context of the market. This improves their ability to make accurate markets that reflect their true intentions. Without pre-trade information, dealers are unable to effectively adjust their prices to reduce balance sheet positions consistently. In other words, if a dealer is long a large position of corporate bonds, they're often missing the data points that would allow them to consistently maintain a competitive offer that could attract order flow from a willing buyer. If you have something to sell, you want to know where the market is so you can consistently have an offer that might attract an order from a customer. That's how balance sheet turnover starts to accelerate in a market that is much larger with a lot less balance sheet. And then finally, access to pre-trade data allows dealers to interpolate markets for less actively traded bonds because quote data can be used when transactions are infrequent or non-existent in a given bond. We've heard that several times from the previous panelists. We've heard people talk about how the ETFs are providing price discovery and how there are other ways that they're interpolating what the price of a bond is. Well, if the pre-trade data was organized in the first place, it would make it a lot easier to figure out where a bond should trade, and dealers could start focus on providing liquidity in a larger universe of CUSIPs in the marketplace because they would have more observable data points to do so. If the corporate bond market making community could be given appropriate access to institutional pre-trade data, their ability to provide deeper liquidity in a larger scope of bonds at a reasonable transaction cost would gradually improve over time. There's no doubt in my mind about that. But to your last question, or at least the portion of your last question, Kumar, you asked, how does this impact evaluated pricing? The direct impact on evaluated pricing is as follows. The evaluated pricing services are obviously incredibly sophisticated and are being relied on by multiple buy-side institutions as well as sell-side institutions, as Derek mentioned, to handle very important vital functions like valuation. We see ourselves as being able to provide higher quality source data to the evaluated pricing services, not as a competitive product. If the evaluated pricing services had curated pre-trade information that was organized and objective and improved in quality, then their ability to not only accurately calculate where bonds should be valued that are actively traded, that would improve, but also bonds that are not very actively traded because there's a more robust source data that could help them. As you heard Mark mention, in March during the prolonged period of stress and volatility, they had 10 times the number of questions that they usually get around the soundness or the accuracy of their evaluated pricing in corporate bonds. This is not because their service broke down. It's because the underlying source data that they rely on for calculating the prices or the evaluated prices broke down. We think that we can help with what's been mentioned. I love this. Somebody said a breakdown in consensus. BondCliQ is designed to actually reduce the breakdowns in consensus to actually create better market-driven consensus pricing. We think if from a structural standpoint, if you're asking about recommendations going forward, the centralized pricing approach is what we recommend to improving the overall quality of data. Dealers must see markets in order to improve the accuracy of their markets and the reliability of their markets. Without more data points from the dealers, as we've heard already on this panel, I think it will be very challenging to continue to support a market that is growing in size and risk with limited balance sheet if we don't improve data access for dealers.
Thank you, Kumar. Chris, I know you had a follow-up comment. If I can, I'm willing to just go to you first before we go to the questions, and I know you wanted to respond.
Oh, thanks so much. And Terry, I think that your question on what are the incentives for dealers is actually at the heart of how we get to a marketplace that has better quality pricing data. As we all know, primary dealers or dealers are the primary providers of corporate bond data. And in order for them to provide this information consistently and competitively, I think a couple of things need to be made available to the dealers. One, there has to be some protection of the proprietary information. So we have a protocol in which the dealers only show markets to other dealers when there's already a consensus of pricing and a lot of dealers participating. So if a dealer is the only one quoting a bond, that is not visible to other dealers. So to your point on why would they put their information out there, you've got to have the right protocol to protect them. Two, we think a very, very critical aspect of dealers making better prices is if order flow starts to be directly linked to the quality of your pricing. I think dealers are all focused on being able to attract buy-side institutions to engage them so they can turn over their inventory. That's pretty much the name of the game in all market making. And so if there was better connection between the quality of my price and the competitive of my price and my ability to actually encourage customers to engage me, you would see dealers consistently making markets and accurately making markets because it allows them to turn over their book. And then finally, I do think, just like any business, the dealers must have some sort of economic incentive for their pricing information. We all know that dealer pricing data is very valuable. It's literally the part of every single pre-trade pricing product that's out there has some contribution from the dealers. But to my knowledge, except for our initiative, nobody has a compensation model that allows the dealers to be paid for the information that they produce. And I think that this is critically important because if we look at other markets outside of the corporate bond space, we see the dealers consistently providing pricing information and then consistently having to pay exorbitant prices just to access the data that they help the market create. We think there needs to be better balance here. And if you can bring that structure to the market, as we've done, you're going to be able to attract dealers who see what's happening, where the market, because of size and risk, requires broader access to pre-trade, but the appropriate application of transparency is critical to getting it right in the corporate bond space. Thanks, Terry, and thank you, David, for passing it to you. Just, Michael, a quick thought here. I think it's important to note that while 85% of the tickets in the corporate bond market are less than 1 million in size when we look at transaction data, it only accounts for roughly between 15 to 20% of the trading volume in the marketplace. This puts a real premium on the pricing data for the institutional market, where there are very few trades relative to the odd lot market, but it obviously generates the majority of the volume on a daily basis. So where we think there needs to be further examination is how are odd lot prices being used to determine the valuations for block positions? Because when you're using a lot of odd lot data to make a determination as to where to trade a block, you may be providing a false sense of where the market is for someone who really wants to understand where I would need to liquidate. And I don't think mechanically it's possible to liquidate at some of the levels, a block at some of the levels that are being indicated by odd lot markets. So it really takes a clear distinction on what data set you're using if you're going to be evaluating a block position in terms of its true value in the marketplace.